Now we have a panel discussion led by the president of Ally Invest, once again, Lule Demese. And we would like to welcome our guest panelists, Dr. John Roberts and Alex Kerr from Investopedia. The topic is trends versus reality in investing. And now I'd like to hand it off to Lule. All you, Lule.
Thank you so much, Brian. Good afternoon, everybody. And be sure to stick around for that Cali how-to. It's a really good sort of short, digestible piece that addresses some of the stuff we talked about earlier on today, which is like we get overloaded by so much. We want somebody to sort of distill things for us into how-to, so stick around for that. So I'm really excited about this next session because this session is going to be talking about data online and people's behavior with data online and what that looks like when you compare it with actual trading and investing behavior by people. So with that, I wanted to first talk about, part of, the markets kept everyone on their toes in 2020, and they continue to do so. And investing trends shifted just as quickly as investor emotions did. But there was also an element of sort of investor savvy that grew out of this time that we lived in. And Investopedia is a popular online encyclopedia for investing topics, if you will, that people go to. So they get to benefit and see all these search results. Think of it as, the Google for investing that allows them to see what people are looking for, how they're searching about it. And then we get to juxtapose that with what people are doing and who they are and what demographics they fit in. So it's a real treat and insight on a combination of looking at what's happening in our world and the data, the footprints of people in terms of their search results. And so one of the folks, the two folks that are going to be joining us today are experts from Investopedia, John Roberts and Alex Kerr. And they really will help us to identify really what consumers really putting their money, where was their saving behavior and where were they putting their money thereafter? So we're going to be breaking down most of the popular questions of 2020 and what they could mean for investing and retirement, back to the theme of retirement and investing for retirement. So with that, I'm really excited to kick it off. Welcome, Alex and John. I hope everybody can see you. And I thought maybe we could kick off, guys, with a first question of the day. So again, we're doing some of these audience participation polls just to keep things interactive with you, even though we can't see you in the same room. And so the first question we want to ask you is this: did you trade more or less during this volatile time of 2020 and 21? Did you invest more or less? And that will be helpful. We'll get back to that answer once everybody answers it. But with that, let's welcome our panelists. Hello, everyone.
Thank you for having us.
Hi.
It's lovely to be here.
Lovely to see you as well. So let's get started in the theme of what surges we saw in the self-directed investing landscape. So can you help us really look at the context of 2020 and let's look at it through the lens of what were the events that happened and how you saw it from the lens that you sit in. And I know we have a slide coming up and I'll make sure we share that as well as you get started.
Yes, I'll kick off on this one. As you said, when we help so many people with the challenges that they have, right? When you're a site that doesn't tell people how to invest, but rather is helping people when they come to us to understand how they should invest, you see all these different changes in user behavior that highlight the questions people have. Now, in a normal year, it's actually really predictable, right? You can actually see day by day, week by week, month by month, this kind of pattern of investing and trading as people go through quarters and earnings reports come out and people do their rollovers and plan their tax season, where you can see all these trends that happen in the population. And because we have a really stable baseline with this audience, we can see when even small things change what people's questions are. Last year was not a normal year, right? There were some things that happened. And this is just a quick summary of what that looked like. I know that even January feels like a decade ago at this point, but we all lived through this, right? We all managed to go through a year that looked like this. And so you see the absolute crash that happened in March. You see the rapid rise, which was not a smooth rise. It was bumpy. We saw oil going negative. We saw the election happen, which any normal election causes volatility. This one caused more than most. And then you see vaccines getting approved, and you see Bitcoin and Tesla. Like, there are a ton of things that happened last year. And at the same time, you have all these government initiatives that actually change how the market works. So even the basis that people trade upon was very different. And a key thing that we're going to come back to a couple of times is, with the uncertainty about what was coming, companies also stopped giving forward guidance, which changed a lot of even how the world is trading, right? And it leveled the playing field in a significant way between institutional investors and retail investors. But this is the world we live through, and it is not the case that we are yet at a point where the future is predictable. So we see a lot of volatility as well.
Yeah. No, it's very interesting. I think it's, there's a picture is 1,000 words. Like, seeing those sort of data points, you realize how many events were stacked in a year that in the past would be a multi-year event, right? Tell us a little bit, where there's a rise in engagement across the board among new and existing investors. I think that is, that's been said several times and it's been proven out. Can you help us understand the key drivers as you saw them? And I know there's some visuals you have for us, but give us a sense of what those key drivers are, and especially in the time of COVID and what happened.
Yeah, so we actually happened to start running an investor survey where we asked our readers to share, what's bringing them into the markets, what's taking them out of the markets in February of last year. We obviously had no idea what was coming. And so we have been running that survey each month for the past year. And beginning in February, going through March, we were asking our readers to share, what are you feeling? What's the sentiment behind what you're buying, what you're selling? Are you bullish? Are you bearish? And it turns out that, as crazy as last spring was, it made everybody do something. But what they did was completely split down the middle. So when we asked people, are you investing more or less money? A third said, I'm putting in more. A third said, I'm not doing anything different. And then the last third said, well, I'm taking it out. I'm investing less. We asked them, how often are you investing? A third said more often. A third said no change. And a third said less often. So there was a lot of commotion with retail investors, which it makes sense. It was a crazy time. Nobody really knew what was going on, including the companies themselves. And so it turns out, when you ask retail investors, how are you reacting to this? What's motivating you? Everybody had a different answer and everybody had a different action. So we saw a lot of that confusion in people's actions, as well as in the media and just in life in general at that time.
Yeah, that's an interesting point, because I think typically when we think of a trend, we think that it's somehow singular in its motives, right? If the trend's happening, then it must be a singular motive behind it. And I like this. If you could just go a little deeper on this for us, like, how is it possible for a trend to have such divergent sort of motivations for each one? What made this past year, or even as it goes on, it feels like 2020 is rolling forward in 2021. What made it so that there was such a high degree of willingness to change and wanting to take action, that this multitude of divergence of opinion as to what they will do and why they will do it?
Yes, I think it's important to realize that in this case, everybody was dealing with a situation that they'd never seen before. Whether you were new to investing, whether you were an experienced institutional trader, whether you were dealing with a housing situation that was new to you, right? All of people's lives were upended. The world which helped us make those decisions was upended. And so people were making and are still making big life choices around their financial lives, right? Which is also their whole lives, right? We've seen this big movement of people out of major cities into houses with gardens, right? Not a shocking change. We saw a huge investment in people buying cars. And we're seeing people kind of, because we're making these choices, you're addressing your financial life, you're addressing that investing challenge, and they're jumping in to make financial decisions in a way that you could always put off before. But this year caused everyone to reevaluate their financial position, but everyone's situation is different. And so that has caused these kind of wildly divergent paths that people are on. And it's this is always true. People who are in their 20s, you've got some disposable income for the first time, have the opportunity to take fairly risky approaches, but they don't have a lot of assets to do it with. We saw that really emerge at scale. I know we'll talk a bit more about that later. It was a big story for the year. But equally, people approaching retirement were making decisions and saying, oh, the market's dropped. I've been in the market for long enough that I know there's an opportunity now to take some cash off the sidelines and put it to work, right? Because we know this is going to rebound on a 5 or a 10-year time horizon. So if I'm in my late 50s, we saw that savvier group, that more experienced group, taking the opportunity to invest into something that wasn't options trading in oil, but was an opportunity to get into like much broader, more distributed investments that they knew were going to give them a bit of a lift as they headed towards retirement.
Yeah.
So everyone's situation is a little bit different, but it was easy to see this drive to action that was caused by the events.
Yeah, and I think that's an interesting sort of the interesting dynamic of 2020 is that we do see retail investors start behaving in some ways with the wisdom of what the smart money used to be called, right? They are the smart money in the sense that typically, I remember when we were going through 2008, that could not be relied on, that people saw a downturn as an opportunity to take money off the table. There's a lot of people that got nervous and put money and kept it still out of the market. So it's an interesting sort of shift that you're telling us about, where people are starting to look at downturn as an opportunity to put, especially retail investors, putting it into the market. Tell us a little bit. I'm curious, the thing I'm so envious about your engine is it's like, everybody knows if you look at, Google search stuff, it tells you a story, right? Tell us a little bit about your search engine and what it tells us when it comes to new investors or traders, new investors, long-term investors or short-term investors. What are they? Are you looking at things that are displaying more short-term objectives in their questions or more long-term trading strategies? And if you're looking at and you're seeing both, give us a little bit more color about those two.
Say we're actually seeing both. We get to look at not only the queries that bring people to our site, but what they're reading on our site. And even just before all of the craziness in March, we started to see people researching, how do I handle this? When do I sell my stocks? Should I buy the dip? It was very self-educational, and it makes me feel good to know that we could help and that people are even thinking that way. And so prior to the correction and then the recovery, we saw people searching for information around corrections and buying options and literally, how do I buy the dip? Buy the dip was the phrase of last spring. And so I'd say that people absolutely learned something from 2008 if they were invested then. That's actually a question we asked in one of our surveys. Did you have money in the market in 2008? If so, did that impact the way that you traded this past year? And the majority of people said yes. And so I think whether or not you were in the market in 2008, you probably had a friend or a family member or even a coworker who was, and people are learning. They're learning from each other. They're learning by going online and going to Investopedia. And so I think we're seeing a new generation of retail investors who don't necessarily panic sell. They might sell, but they do the research. They educate themselves first. And we can actually see all of those topics that they're turning to as they plan out, here are my ideas, here's what I think is happening, but let me check and make sure before I actually put my money on the line.
Yeah. Tell me a little bit, you guys mentioned about risk appetite. And after this question, we'll probably open the results of our poll just to see what people's answers were. But you mentioned risk appetite. Give us a little bit of sense from either the surveys you did or the search results that you saw, behavior that you saw. How did the question of risk change or adjust in 2020?
I think everyone suddenly understood that risk provided an opportunity. Right. And I had not predicted this was where we were going to go in an event like this. There's an Ipsos study from 2019 where millennials were asked at scale, are you invested? Why are you invested? What do you think of the markets? And 43% of them said, no, the market is too risky. Right? This is at the end of a historic bull market run. And 2020 comes along and it's basically hold my beer, right? And the market collapses and they're all proved right. And we see the results of this being running into the market as it goes on fire, right? So having seen the data, like I'm staying out of the market because it's risky, when the market delivers on that promise, then a lot of investors are like, aha, yes, now's my time. I will get in, which is less about buying the dip and more about jumping into investing at all, right? It's the biggest possible version of buying the dip. Now the market has crashed. Now I am going to get started and understand what this thing is, which is, you could call it a lot of risk appetite, but it's also a statement of we took a lot of risk off the table when the market corrected in March, right? Because a lot of things unwound that were probably overblown, right? A lot of the initial drop came from positions that were not sustainable. And so that put things on, we can now, with hindsight, say a more stable foundation, right? Although there was a ton of uncertainty at that point about where we were headed. And obviously the Fed took a lot of risk off the table, right? Backstopping piece after piece after piece of the market. The tactical detail of that risk appetite shows up in people's investing and trading strategies, right? And so what we saw in March when volatility was going through the roof was, obviously we saw the how do I buy the dip? How do I understand equity risk? And started to talk about like index funds and portfolios for a bear market, which is a very low risk kind of investing strategy. But we saw an explosion of interest in trading volatility, right? Inverse ETFs, leverage ETFs, all of those pieces that then morphed into sector investing in more volatile sectors, right? So it wasn't just, I just want volatility because I want to be able to get some opportunity here, but starting to build strategies around sectors and betting on the recoveries of those at different points. So airlines, cruise lines, but also tech sector. My favorite of the pandemic trades was the basket of beer, weed, and video games, right? All of which clustered together in a similar audience. It's like, oh, we're going to be locked down for a while. This seems like a growth area. Nobody else knows anything that I don't know. I'm going to invest in those. And it was a great trade to go in for at the time. It totally worked, April through May. And we see the audience kind of building into that. So it's both risk for the sake of risk, but also these very volatile sectors that we were all trying to figure out how they were going to emerge, and people seeing that there was an opportunity there. Fascinating to watch.
Yeah, I love this idea of sort of correlations that we would have never guessed for, but for the fact of the constraint of all of us being in a house and locked down. Let's pop up the answers to the first set of questions we asked, and then we'll proceed with some of our conversation if we can, team. So, whoa, look at that. I think your data matches what our viewers are saying they did as well, right?
That feels about right.
And it's a self-fulfilling prophecy, to say the least, but it's a really interesting one. So thank you, audience. And look out for more live questions that we'll be asking throughout this session. And again, we're going to be doing a Q&A later on with John and Alex. So make sure you send in your questions as well, so that we'll be able to address them later on. So before we move on, I want to ask you a few more questions on this idea of the surge of the self-directed investor. And how do you see self-directed investing, the disruption that we lived through, and how there is clearly, undeniably, this active involvement in self-directed investing, however you do that, whether you decide to buy a security or a robo, whatever the vehicle that you pick, beyond what it's shaped us throughout these 2020 and 21, how do you see it emerging out of this pandemic?
It's funny, if you look at this from a media perspective, you've got so many financial publications who have been talking about this, and nobody really knows yet. We were all pretty flabbergasted coming out of last March going, like, things are bad, but the market's coming back. People are buying in. What's going on? This is not sell high, buy low. This is not what we think normally people would be doing. And so, again, based on what we asked people about how they invested in 2008, when major life-altering events like this happen and it becomes a once-in-a-lifetime investment opportunity, I think people are going to learn. I think this has changed retail trading, at least for a while. And so we're going to see people who are a lot more active, people who weren't necessarily in the markets before, but are taking a sense of ownership for their money, for their future, for their retirement, and saying, look, I can learn this stuff on my own, or I can turn to a professional but I want to be involved. I'm not going to rely on a pension because they're not there anymore. I've got to do this myself. And so when you've got a year like 2020 where everything got turned on its head, I think it encouraged people to embrace things that maybe they wouldn't have embraced before and take control of things that they weren't taking control of before. So I absolutely think we are going to see a lot more from retail traders, and 2021 has proved that to be true. So I'm excited for what that means for us as a company. I know for Ally as well. It's going to be big for retail traders. They're not going anywhere anytime soon.
Yeah. No, and it's interesting. It's one of those, investing is one of those bugs. Like once you've caught it, it's you realize not only how important it is to build your future wealth, but how much fun it is as well. Done well and with responsibility and advisor and everything else that requires. But there is, the element, I think, of how engaging it is as well, in addition to prudent sort of adoption of building our assets for the long term. So let me ask you this now. If I had to ask John to you took the over on this one, Alex. Like, John, if I had to ask you the under on it, if we emerge out of this pandemic, where would you see the data that you've seen so far? I'm sure all of you are, academics and analytical people. When you're talking about the under of it, should it get a little less disengaged? Where are you? What are those watch items for you?
This is if an audience were to become less engaged.
Yep. Pandemic ends, we're all back to work.
I think
what Alex said.
Yeah, so I think where I would look is this, like the day traders that caught so many of the headlines, but were only a fraction of the actual change in investing behavior that happened this year. Just it was the biggest piece of this. I think there's a couple of things that are going to happen which will pull back that particular trend. Firstly, as we get to a place with a more stable future in which businesses are reopening, how the economy is working, investing just gets a bit more boring, right? You're actually having to read earnings reports. You actually have to dig deep and figure out what boards are doing, what they're made up of, and what these investment plans look like, right? There isn't the same, I don't think we're going to be investing necessarily in bankrupt stocks at that point, right? We're not, I think there is a less likely chance that we're going to end up with those events in the future, which just pulls back from some of that excitement.
Yeah.
So that's where I would look to see it pull back. But where I don't think we'll see a change is this rise in investing, right? And it's a rise in people who have become invested in the last year, who now are much more comfortable with it, because the best way to learn about money, and particularly your financial future, is to just start, right? And we saw so many people start that just a level of financial literacy and education has taken a step up, right, in 2020 and 2021. And also the move to online investing, right? There's the change, not just from having investments, maybe it's in a 401k that sits over there, which you kind of never touch because you weren't sure what to do with it, to being much more directly engaged because you have it at your fingertips. Those two trends I don't believe will change. But I do think the day trading trend is going to pull back.
Interesting. So essentially, we may end up taking the best lessons of what 2020 and 21 did, which is widen the involvement level and the engagement level of people partaking in investing, which that sounds very encouraging. And it sounds like we need to have you back again, talking about what those trends end up showing up as in the search behaviors of your users. So now what I want to shift to is discussing, first of all, before we shift to this topic, can we pop up a new audience questionnaire, team? So this question, and we're asking this question in advance of the actual conversation we're having with the team, but is asking you, what was the most influential sort of source of financial information for you in 2020? Was it TV commentators? Was it social media influencers that you follow? They could also be TV commentators, but the social media genre has grown as well. Or was it your own research, whether it's because you went to Investopedia and did that research, or you are an avid reader of earning reports, whatever the source of research is. And we'll come back to that in terms of what people say is their primary source, at least throughout this pandemic, in terms of their investment decisioning. So I look forward to seeing that. So, John and Alex, now I would like to shift now to what you saw in terms of investor tendencies, especially. I know you might not have the ability to understand whether it's retail or institutional on your search. Maybe you do, but some of the tendencies that you saw. So, in terms of the acumen of the retail investors, typically sort of looked down on, right? The adage of they buy high and sell low. Did you find that myth to be a myth this cycle around in terms of when you saw the timing of people researching, or did you see some of that affirmed?
I mean, I'll hop in quickly. I think that's changing. I think after what we saw this past spring with just the frenzy of buying, and not just buying and trading, but talking about wanting to trade ideas, the average retail investor isn't a pro yet, but they're getting a lot more involved. They're doing their research. Again, phrases like buy the dip. I mean, that's literally the exact opposite. People are understanding that, okay, this is really scary. When markets tumble, it's frightening, particularly if you're already invested in the market and you're watching, your brokerage account turn red and go lower. But it doesn't mean that you have to sell. It doesn't mean that you have to take action. It doesn't mean that you have to panic. And so we don't know yet if that is going to stay past 2020 and 2021. But I would say over the last year, that stereotype isn't necessarily true anymore for retail investors. They're changing, they're growing, they're adapting.
Yeah. And sorry, go ahead, John.
No, I just agree with that. We see a little bit of a signal of institutional investors because we can see kind of broadly where people are researching things from. And Investopedia, it turns out, is a very good resource in Connecticut and Wall Street. It turns out also at the federal government buildings do seem to have a tab open on a regular basis. But when you look at the weight of people coming in, right, that there's obviously a lot more retail investors than there are the institutionals using the site. And I think this year it was fascinating to see that we have articles about when to sell, right? And it's a really interesting one. And we also have articles on buying call options and put options, which is a good just idea of like which way you're going on the market. And consistently throughout the year, when there was a dip and there were many dips, I assumed we'd see this stereotype, which is you'd see the when to sell your stock peaking the day that the drop happened. What actually happened was we saw it peak the day before. And the biggest version of this is the orange line sitting right here, right? Where that is when the market corrected, right? That is the day the market corrected. The gray in the background is the VIX, right? That's a measure of volatility. So it's pretty flat going into the year. It rose, it peaked during March. The orange line here is how to handle a stock market correction. Obviously, that peaks the day the market corrects, and people are trying to figure out the strategy to handle what's going on there. But where I want to take your eye is that it doesn't just start on the day, it's actually already up over 100% on the Sunday before the market corrected. This is the wisdom of the crowds, right? I'm not saying any individual retail investor knew the market was going to correct before it did. This was a very sharp drop that happened late that week. But the overall interest of all the retail investors had already driven a doubling of interest in stock market corrections way before it actually corrected. Now, we could all read the headlines around the pandemic, around risks to the global economy, but it was the Sunday before that people saw this happening, right? And that wasn't, oh my God, should I take the money out, right? That's not this group of intent. It is exactly that. What is risk? What is equity premium? How do I catch a falling knife? How do I buy the dip? What is the correction, right? And people went in understanding that before the market corrected. The two later trends here, the green, which is a little faint, is the how do I trade volatile ETFs, right? That's the figuring out this new abnormal that we were in, right? Kind of negotiating what to do in the middle of this crash. Whilst CNN was saying is the world falling apart, right? The trading audience was trying to figure out how to leverage this and make a sensible strategy during it. And the blue line is all around that kind of reopening trade. How do I build a sensible portfolio? How do I sector invest through this in a way that is going to build a successful portfolio for the new abnormal we're heading into, right? And this is a much smarter version of navigating this than we ever expected, right? There's no panic in this chart. There is just people trying to figure out the best way to invest during these different and evolving times very quickly. The reaction time of a retail investing audience was very fast through the volatility of 2020.
This is fascinating. It's almost like the orange line is telling us that they're savvy enough to get situational awareness before it happens, and then get opportunistic in terms of how to skin it and how to interpret it, essentially. It's really fascinating. I'm curious to see, actually, the next time that gray goes up, what happens to your orange, green, and blue. So that would be a really fascinating thing to see. Okay, so now let's go to, in terms of so we've now dispelled, if you will, the myth that the retail investor is the dumb money. I think we have clearly dispelled that myth. Now let's shift to your perspective and what you see on the retail investor's prowess to becoming the smart money, right? Sort of the leading indicator. Anything in your searches and the juxtaposition of whether it's a VIX or otherwise that has had you thinking about that question?
Back to the survey that I had mentioned earlier, we did have a fair amount of people who said that they were bullish throughout this entire experience in the past year. And we started to notice that bullish retail traders were self-correcting as we moved throughout the year. So when we asked in April, are you putting more money in the market? Are you trading more often? For the people who said yes, we asked them what they were investing in. And overwhelmingly in April, it was airlines. We still thought maybe summer's going to be okay. We're going to come back out. We're all going on vacation. Can't wait. Millennials by far prefer Delta for whatever reason. Great airline. And so as we moved through the spring and everybody was very optimistic, it was all about airlines. Come June, when it became clear that we're not going anywhere, we're staying home for a while, we saw those same self-reported bullish traders saying, well, I've moved my money to tech. And so you can see people starting to adjust their understanding of, what's going to make money, what's going to be a healthy business if we stay in quarantine for a longer time. And so it was same people, same sentiment, but they're shifting where they're moving that sentiment. And so starting around June and ever since now, for 6-7 months, it's been in tech. It's been in businesses that can operate in the cloud. You don't need employees coming in. You don't have a physical product that needs to be distributed. And so it was really interesting to see these people educate themselves, correct, and make the smart choice. And they've stuck with it ever since.
Fascinating. So now shifting from a sort of, what I'd love for you to help us understand is, there's a term that, people have heard throughout 2020 and 21, and, you hear it, whether you're watching Financial News Network or otherwise, that, this may have been one big momentum trade, is what we hear, right? First of all, can you explain to our audience what that means and what your search results say about that claim?
Yeah, I think to very simply structure it, it's saying when enough people are investing behind a particular set of stocks, the price is going to go up, right? And so if enough people keep pushing behind it, independent of any fundamental underpinning for that growth, the market's going to go up around that group of stocks. Which is also just to say, if a lot of people know that there's a good reason to invest in something, like a momentum trade can still be a good, fundamentally viable trade, right? If everyone's like, oh, this seems like where we're going, let's all get on board, right? Then we're just putting our money to work in the industries which we know are going to be the industries that we all want to invest in down the road, right? It's allocation of capital if it's actually based on something, right? I think the fascinating thing about this last year is there wasn't a lot to go on that wasn't this, right? There hasn't been a lot to base a trading pattern on. And a lot of what you base it on are the headlines, right? When you find that the US is going into a national lockdown, then there's obviously a foreign exchange trade to be had there, right? Because you're betting on geopolitical trends, right? You don't need any special insider knowledge to know that these headlines drive businesses, drive markets, drive economies. And so when I talked a little bit earlier about leveling the playing field, that's what I meant, right? There isn't some specialized unknown thing hiding in the data that can overwhelm what we can all see happening in front of us, right? And I think the retail investors as a group realized, firstly, when there isn't that level of mystery, there are sensible bets to be taken.
Yeah.
And that when everyone can see those same trends happening, other people are going to get on board. And that actually does lift it. And it is a kind of a self-fulfilling prophecy, which is good if you get in early. It's dangerous if it's a bubble, right? There's real risk here if this isn't actually underpinned by something which is going to be on the other side. But if the momentum trade is, I'm going to invest in things because this pandemic's going to end and these businesses will get better, that's a pretty sensible momentum trade, right? If your momentum trade is, I think tech is going to be a winner because all these businesses suddenly have to go online and they're all using AWS or they're all having to build shop fronts online, those are some pretty good trades to get in on, right? There's no really complex fundamental that you're looking to there to underpin like a broad ETF bet on technology over the next 5 or 10 year time horizon, right? I think in this last year, that has been a very sensible trade, or a lot of these could be argued to be very sensible trades. And we've seen retail investors do them at scale and come off very well, right? Because a lot of those bets have proven out pretty well.
Fascinating. So we're going to shift now to some very specific search results that I want to talk about with regards to instruments and what they look like, and if you see a differential between folks who are planning to use those instruments in their IRAs versus their taxable accounts, et cetera. But before we do, can you pop up the results of the audience poll we had? So look at that. I'm actually really surprised by that, and happily so. The heavy element of my own research. And we didn't coin research just consuming social media and TV personalities' perspectives, right? We said your own bottom-up or reading or top-down research that you do. And look at that. We have a very studied viewership here, and I'm glad to see so. Any reactions from your perspective, John or Alex?
I mean, it makes sense. It's what we've seen all year. People are doing a lot of their own research. They're educating themselves. And touching on what John had just said, something else that was really interesting about last year was it wasn't necessarily traditional media and headlines driving momentum, driving people. It was their own research. It was talking to friends and family. It was social media. And so it makes sense to me that most people are going to say, no, it's me. I'm doing my own homework this time.
Yeah. No, it's heartening to see. Okay, so let's get back. We'll have another fun question for our audience later on, but let's get back to using, understanding investor habits of research when it comes to, for instance, as an example, before we do that, actually, can you quickly describe for our audience the fundamental difference between a stock and a pooled instrument like an ETF or a mutual fund?
Do you want me to take that, John?
Go for it, Alex. You can take this one.
The most simplistic definition is if you're buying a stock, you are buying a share of a single company. That can be great for profit, but it's incredibly risky. So people who are a little more risk averse tend to go for a pooled instrument like an ETF. So I've described that almost like buying a slice of a pie. You're getting little bits of ingredients, little bits of different stocks, but you're not committing to any one stock or any one company. So it's a little safer.
I love the fact that you explained all of that without using any internal financial speak. That's very simple. Thank you so much. So
Investopedia.
Investopedia. Let's now go to tell us the investor search behavior between stocks and pooled instruments. What do you usually see of that, the difference between the two when they do searches, and what changed in 2020?
I mean, earlier on in the year, as we saw people first starting to adjust to, what was happening in March, we saw a lot of interest around gold ETFs, airline ETFs, but then you also saw growth ETFs, healthcare ETFs. So I think the concept of a pooled instrument made people feel a little safer, almost regardless of what actual sector they were going into. In general, though, when we've asked people their sentiment, why are you buying, why are you selling? the people who say that they're investing in ETFs tend to lean a little bit more bullish than bearish. So we're seeing interest from people who aren't necessarily going that way because it's safe. It's just safer.
Yeah. Interesting. So sort of the wisdom of the crowd of the investment vehicle itself, if you will. And then tell us a little bit about, one of the sort of the trends we've seen over the years is a move to more ETFs versus mutual funds. Not that there aren't humongous consumption of mutual fund, but especially generationally, a growing shift towards and a steady shift towards ETFs. What did you see in 2020 on that erosion?
I mean, again, we saw
I think
that
we have
split
seen...
actually. Sorry, I'll just go quickly. We saw that split actually happen between ETFs and mutual funds, where when people self-reported as bullish, it was individual stocks and ETFs. When they self-reported as bearish, mutual funds were now a more attractive purchase for them. So now I'll toss it over to John.
That's fascinating.
No, I agree. And we do see the erosion over time, right? We do see that ETFs are definitely replacing mutual fund interest over time. We see a younger audience tend to spike around ETFs for sure. There was a cost element that is a differential between these two instruments to get into. But a lot of the ETFs allow access not just into a sector, but even maybe a trading strategy, right? The volatility ETFs that really spiked up in March and April were not just an instrument, but like a tactic, like a way you want to get into the market. And we also actually see ETFs as something which particularly younger investors understand in a way that's a little different from an older investor, right? So we see ETF interest amongst a younger audience as this kind of decision between should I get an ETF or a mutual fund or a high yield savings account, right? Which is more a statement of intent of I've got money and I don't really know where to put it, right? This is a decision between like wealth growth instruments, right? As opposed to a decision on like some fine-grained investing debate. Whereas when we see more mature investors, we see people actually trying to pick the best ETFs. So it's more about trading and investing strategies as opposed to betting between different ways of even getting into an instrument.
So we're coming closer to our end of time. So I want to pop up one more question. And this is an audience question. So take out your keypads, everyone. And this question is, which generation do you think, as the viewer audience, which do you think was most active in 2020? Whether it's active in investing or opening accounts, do you think it was the boomers, which typically is people who at least now are 57 to 75? Do you think it was Gen Xers, which are typically 41 to 56 now? Or do you think it's millennials or younger? Millennials, actually, I think the oldest millennial is now 40. So it's around 25 to 40. So which among these folks, this generational bucket, do you think drove the activity of 2020? So I'm curious to see results, and then we'll shift over to Jonathan and Alex to see what you tell us, what people actually did. So just looking at the results here, the bet is on millennials. And I have a feeling you're going to be doing some myth busting for us. Not that millennials were not active, but the humongous bet is the millennial sort of population. So now I want to shift into sort of what your results and your data has told us about this. So we'll kick off in terms of, before we kick off into the questions though, as you see those results, any surprises there, any thoughts there?
Yeah, absolutely. I mean, all of the talk around the rise of the retail trader obviously tends to land on millennials, particularly when you're discussing, mobile first brokerages. And the funny thing is, when we actually looked at the data, that's not true. There was a lot of interest in 25 to 34-year-olds. About a third of new brokerage account interest came from them. But, and I'll toss it to John for the big reveal, that is not the end of the story. It's not just millennials.
Yep. So I will pop up that screen. So John, as you start talking, we'll make sure we show the data around it as well.
Yeah, we saw about a doubling of interest amongst millennials in just intent to invest, right? People coming in looking for the best platform, the best tools, the best strategies. But we saw over 180% increase in 65 plus, right? So every decade you are older, there was a much, much greater percentage increase, right? The largest single bucket is still at 25 to 34 section. So as Alex said, millennials account for about a third of all new intent, new account interest. But the older you get, the bigger the rise was. So it was actually a leveling of the playing field, and there was a lot of other people catching up and bringing themselves into the market in a way we haven't seen before. And partly this is about a generational shift in how you invest, right? We're talking here about online investing. This isn't to say that this 65 plus audience wasn't already invested. It's just that they're newly investing online, right? And if we think about this, right, we all became digital natives this year, even if we didn't live on a laptop normally in our day-to-day world, as a lot of us who are in the workforce do. We are now on Zoom calls. My parents literally are on a polytunnel Zoom, so I apologize for the bad connection. They're figuring out their planting strategy for the spring in the background. They do online yoga, right? This is a new set of skills that I honestly didn't think would happen at a global scale. We are seeing a move online from older audiences that could not have happened, but the pandemic has made us all digital natives, both in our lives, and this clearly shows in our investing.
Fascinating. Thank you so much for that. So we're going to shift over now to Q&A because I'm sure the audience has some questions, and we'll bring Brian into this conversation, our moderator for the day. Brian, what questions do we have for John and Alex from our audience?
Well, they're definitely loading up the chat box, and I always want to make sure that we can keep putting them in the chat box. We're happy to address them. So first one that I have is from Caleb. Caleb, he says, this question is for Dr. Roberts. Investopedia is also a part of Dotdash, which has 12 other websites. Any interesting data across the sites that is worth mentioning?
This is... it's fascinating, right? As we said, for Investopedia, when the world changes, we can see it in how people are coming to the site. Right? The world changes, people come to us to figure out what to do about it. That's on the investing side. We also cover people's homes, their travel plans, their tech challenges, their food habits, their health issues and concerns. And so in exactly the same way as we see this on the investing side being that initial spike where the market corrected and people trying to figure out what the hell is going on, how do I deal with it? And then that kind of bargaining section in the middle with volatility trading that then turned into investment strategies to the new normal. We saw the same trends across all the sites we run. Across, when you roll up all the audience, it's like 10, 11, 12 million people a day that we can see the challenges of. So it's this amazing sense of interest to have access to. I think my favorite one from this actually comes from a lot of our home and food sites. You start off, we saw a massive spike in interest in toilet paper, obviously, right at the beginning. We were all there at that point when it was flying off the shelves. And at the same time, we also saw a massive spike of interest in bidets. Because people were like, maybe there's no toilet paper. Maybe that's a problem I have to deal with now. What is the other solution? So if you actually go back, you'll find that Amazon sold out of bidets around that time because we saw the spike and then we saw the result happening in the world. And then you got that middle phase, which is what I like to call the sourdough phase, right? Where people are like, I'm going to bake bread. This is a new project I'm going to get into. And then they ran out of yeast, so people learned how to deal with sourdough, right? That's like, oh, this is a new thing. I'm going to figure out how to manage through it. And then we saw what I think was the most dramatic trend here, which was as we came towards the end of April, we saw a rise in interest in gardening, which is not unexpected. Spring happens, it happens every year. But we saw a wildly outsized rise in interest in planting vegetables, which is the clearest example like, oh, this is going to be a while. Right? We're in this for a bit. Get ready. Let's start to become just that little bit more self-sufficient. But it's kind of that resilience, right? It's seeing people becoming resilient to a changing reality that they're having to deal with. And we see that everywhere. I mean, the health trends are health trends and they're fascinating. But there's a lot to dig in and across the whole piece. And as we enter 2021, we're seeing a lot of this settle in as new learned habits, as new things people have got that they're using.
I mean, I have to say that the B-Day quote has to be the quote of the day, Jonathan. I'm going to keep that with me. And by the way, lest people think I am robbing you of your doctor status, it's just because I've known you for so long, I've forgotten how. So I will make sure I give you the deference of Dr. Roberts.
Not the useful kind of doctor, academic kind of doctor,
No.
not the useful kind of doctor. Very important difference.
Absolutely useful. Any more questions, Brian?
Definitely. So Joe is the next person that is in line. Says, what tools do you use to identify some of these search and behavioral trends, both emerging trends as well as some of the cyclical/seasonal trends that you see?
I'll take this one again. So we have this privilege of having this huge audience, right? And so we can see what they're reading every day. And it is just, what is the reading behavior by the page of content, by the area of content, by the topic that they're reading? Seeing what's happening today is interesting, but it's way more useful if you know what you would expect to see, right? You really want to see a baseline and then a change to that baseline. The advantage we have is that these properties, Investopedia, the balance, the rest of the Dotdash portfolio, have been around since, in most cases, like 1998, 1999, right? Many of these are actually older and predate Google. And we have data stretching right back to the beginning of the internet. And so we have this data all the way through to the present day. So we could take 15 years of consumer interest, of the population's interest. And I guess the most surprising thing to find was usually it doesn't change, right? Over 15 years, seasonal interest has been incredibly stable. So you can actually take 15 years of history and you can predict March using all previous Marches rather than saying, what was this February, therefore what will March be? And just think how much has changed over the last 2 decades. To be in a situation where we can actually predict down to a couple of percent the interest in any topic on any given day is wild, right? It shouldn't work, but it does, because actually the problems we have as humans don't actually change that much. It's just that we've gone online to learn how to answer them, right? So we've seen this shift into how we answer the problems, but the problems themselves have remained very, very stable over time. And that stability gives us that baseline, which then allows us to see what has changed on any given day, which allows us to see when an event happens and it kind of rings the internet like a bell, and we see these like ripples and trends that spike around our content in lots of different places. Right. Which is a long version of the answer, where the short answer is quite a lot of math.
Well, that summed it up well. Okay, so I have time for just one more question here. So unfortunately, but Jay Garcia is back in the chat box again, wondering if social trends like decentralization and the age of creator are showing up in Investopedia search trends overall.
Absolutely. I mean, this was definitely the year of the, media influencer. And we've got a funny story that, we tell at Investopedia. Early last spring, right when things really started to happen and we had just gone into quarantine, all of a sudden we saw a huge spike in traffic to one of our rare currency articles. And so we're all looking at each other like, my God, are we going to the gold standard, or are we abandoning the dollar? What is this? And it turns out that there was an episode of Tiger King that referenced a $500 bill. And so we had tens of thousands of people now researching $500 bills. So we get stuff like that all the time on Investopedia. What people are searching for normally is dictated by what's going on in their lives, but occasionally it's dictated by the media. So even shows like Succession and Billions, if they mention a financial term that most people haven't heard of, they come to us to look it up. And so we saw a lot of that throughout the year. And so, yeah, absolutely. I mean, what people are discussing on social media with their friends, with their family, definitely has an impact in their decision making and on our side of things in what they're looking up and what they're reading about.
All right, everyone. Well, that's going to be it for this session. I want to thank you for such a great discussion about trends and just in general overall.